Welcome to The Explainer. If you're anything like me and you love figuring out the nuts and bolts behind massive economic shifts, well, you're in exactly the right place. Today, we're unpacking a truly historic moment in finance, the May 2026 summit of the American stock market. We're going to look at the data, unroll the timeline, and figure out exactly how we got here.
Okay, let's dive right into this. Picture this. May 14th, 2026. The S&P 500 hits a jaw-dropping 7,517 points. I mean, wow. This wasn't just some lucky overnight bump either. It was the peak of 3 consecutive years of double-digit returns. It's the kind of staggering number that literally had Wall Street analysts rewriting their textbooks.
But, staring at a massive number like that immediately triggers a very natural, very human question. If the market is at an absolute all-time high, is it just too late to get in? I mean, nobody wants to be the person buying at the absolute peak right before a massive drop, right? It's a totally valid fear. So to answer it, we really need to look under the hood and break down the facts behind this record.
Part 1. What exactly is SPY? We all know SPY, right? The SPDR S&P 500 ETF Trust. It's basically the undisputed heavyweight champion of the investing world. Buying just one single share gives you instant diversified exposure to absolute giants like Apple, Microsoft, Nvidia, Amazon, Google, and Meta, all bundled together in one neat little package.
And here's a huge reason why it's so incredibly popular. It operates with a phenomenally low annual expense ratio of just 0.09%. Think about that. You're paying practically pennies to hold a slice of the entire American corporate powerhouse. This insane efficiency is exactly why it's the foundational go-to for everyone from everyday long-term investors to massive institutional funds. Plus, the track record totally speaks for itself. Since the underlying index was created way back in 1957, it's generated an average total annual return of around 10.3% when you factor in reinvesting those dividends. It is a literal wealth-building engine. But, as we all know, average returns do not mean a smooth ride. Which brings us to Part 2, the road to the record. Let's take a walk through this incredible timeline of resilience because it has been a wild ride. First, in early 2020, the COVID-19 pandemic triggered a terrifying 30% drop. Yet, remarkably, the market clawed its way back in just 5 months. Then came 2022, a really grueling year where 40-year high inflation and aggressive rate hikes dragged everything down nearly 20%. The climb out of that hole was super slow. We even saw a brief, sharp dip in April 2025 triggered by a trade war shock. But the market just absorbed that geopolitical stress, pivoted, and began its definitive, unstoppable climb to that May 2026 record.
And this brilliantly illustrates the sheer force of that recovery. From the lows at the end of 2022 to the highs in early 2026, the market accumulated a massive 79% gain. 79%. That is an explosive wealth creation event, all compressed into just over 3 years.
So what caused this? Let's look at Part 3, Engines of the Rally. The whole thing basically comes down to a perfect alignment of 3 powerful engines: massive investments in AI infrastructure, incredibly resilient corporate earnings, and stabilizing macroeconomics. Let's break these down one by one, shall we? The first and honestly the loudest engine is artificial intelligence. Now, this isn't just hype. We are talking about cold, hard capital. In 2026 alone, the 4 largest tech companies, Nvidia, Microsoft, Google, and Meta, committed a staggering $725 billion to AI infrastructure. $725 billion? And the hardware providers are absolutely reaping the rewards. Take AMD, for instance. They saw a 38% revenue increase in Q1 2026, completely fueled by a massive 57% growth in their data center segment. The money is flowing, guys, and the profit margins are very real. But hey, it wasn't just tech pulling all the weight. Our second engine is corporate earnings across the entire board. In the first quarter of 2026, an unbelievable 84% of S&P 500 companies beat their earnings expectations. And even more impressively, for the first time in 4 whole years, all 11 sectors of the index showed positive growth. The entire boat was rising, not just the front end.
Finally, the third engine, a really supportive macroeconomic environment. The clouds of uncertainty finally started to clear up. In early 2026, the U.S. economy posted a super solid 2% GDP growth alongside a healthy 4.4% unemployment rate. The Federal Reserve actually held interest rates steady, which totally removed the panic of unexpected hikes. Throw in rising hopes for peace in the Middle East, which successfully pushed oil prices lower, and you've got the absolute perfect macroeconomic tailwinds for a historic rally.
All right, let's shift gears to part 4, Wall Street projections.
When we compare the consensus across the big banks, it is remarkably bullish. Both Goldman Sachs and JPMorgan set a target of 7,600 by the end of 2026. Barclays pushed it slightly higher to 7,650. And Morgan Stanley? They set the pace at an aggressive 7,800. These institutions are modeling an expected 12% earnings per share growth across the S&P 500. And they project that the ongoing AI boom is going to drive roughly 40% of that total growth.
Now, for those of you worried about a massive, fragile bubble waiting to pop, just look at the current forward price-to-earnings ratio. We're sitting at 22. Compare that to the 5-year average of 21.7, and you can see the market is trading right around its historical norm. We simply aren't seeing those extreme, completely detached from reality valuations. Investors are basically just paying a historically reasonable premium for solid mathematically expected growth.
Which leads us perfectly into part 5, investing at the peak.
Now, what's really interesting here is human psychology. Many people instinctively want to hoard cash and wait for a perfect pullback to buy in cheaply. But spoiler alert, you are almost certainly not going to time it perfectly. Constantly waiting for a correction just leaves you sitting on the sidelines. The proven, historically superior strategy is dollar cost averaging, just consistently investing a fixed amount on a regular schedule, rain or shine, up or down.
Why does that work so well? Because the stock market is actually at an all-time high roughly 30% of the time. Just let that sink in for a second. If you absolutely refuse to invest at all-time highs, you are voluntarily sitting out for nearly a third of market history. You end up completely missing the compounding engine that drives real long-term wealth.
However, blind optimism is dangerous, right? So the crucial point here is that markets never move in a straight line, and there are absolutely structural risks we have to acknowledge. For example, Goldman Sachs currently places a 20% probability on a recession happening in the next 12 months. It's not a guarantee, but it is a real risk. Furthermore, there's a bit of underlying fragility because these gains are disproportionately concentrated in just 5 massive tech giants: NVIDIA, Microsoft, Apple, Google, and Tesla. If even one of those pillars stumbles, those ripples are going to be felt across the entire index.
But even keeping those risks in mind, our analytical journey brings us to the ultimate historical lesson for anyone trying to navigate an all-time high. It's an old saying, sure, but it is mathematically true. Time in the market beats time in the market. Trying to outsmart the daily fluctuations, that's a losing game. But letting the world's absolute best companies compound your wealth over decades, that is the winning one.
We've just seen how the American market absorbed massive pandemics, soaring inflation, and trade shocks, only to emerge stronger and crush records at 7,517 points. The structural engines are firing on all cylinders, the fundamentals are actually quite reasonable, and history clearly favors the active participant, not the spectator. So, armed with all this data, what is your next move? Are you ready to build your strategy for the next market summit? Keep learning, keep analyzing, and I'll catch you in the next explainer.